We're going to get started here. Hopefully everybody's had a lunch. Now you're all ready for some great content here provided by Eide Bailey. We've got Josh Raleigh, the tech partner, right? Tech partner?
Tech partner.
Tech partner.
Tech partner.
That's a firm-wide designation. I love that. How do you get to be a tech partner?
It's not by hooking up the technology that's in this room, I'll tell you that much. I get teased in Teams meetings more than anybody when you wear that title.
All right. And we also have Adam Sweet here from Spokane. He is the National 1202 guy. You are it.
I don't know if I'd say national, but I'm
That's a
Eide
good title.
Bailey's 1202
All
guy
right.
anyway.
Mississippi West?
Mississippi West.
Mississippi West. All right. Well, we want to welcome you all. If you've got a question, raise your hand. I'll bring a microphone over to you. This is pretty informal. These guys are the experts. They're here to help you guys with any questions you have on small business stock. We will send the slide deck out to everybody tomorrow. So you'll get a copy of the slides. And in about 3 or 4 days, probably next Monday, after the video's been rendered, it will be on the YouTube channel for Silicon Slopes. So if you want to go back to anything, it'll be available. And so without further ado, let's have a big round of applause for Josh Raleigh and Adam Sweet, Eide Bailey.
I'll introduce you. Good afternoon. We're so glad that you're here. Thanks for being here. Chris, when he offered for us to speak, he said, hey, you've got to have a topic that means something, has a little bit of a punch to it, something a little bit sexy. And so I'll just tell you the story how we came to this topic. So I've been in tech, focusing on tech more and more for the last 10 years of my career as a tax accountant. And it's only been this summer that for the first time I've had a partnership, founders taxed as a partnership, decide that they're going to pull the trigger and convert and become a C corporation, just really to be able to play this play that we're talking about today. Now, to me, that's a big deal because to make a choice to operate as a C corporation in a flow-through friendly world, that's a pretty big commit. But they did the analysis and they want to do it. And so I feel like how many times are we as advisors, and I think there's some in the room, I mean, when we start a tech company in Utah, I think we're starting it as an LLC. Would you agree? We're starting as an LLC because you're getting those losses to flow through. If you do get income, you're getting, QBI income. It's very, very favorable, rather than poking into a C corporation where you've got a double taxation situation. But there is a place for flipping that LLC to a C corporation. And so we might just touch into that today. And I think it'd be helpful for us to know a little bit about who we're dealing with here. So could I just have you identify yourselves? I think we're probably a mixed crowd. How many of you would consider yourselves advisors to the tech community? Attorneys, CPAs, fractional CFOs, okay? And how many of you would consider yourselves operators in the tech community? Okay, we've got a pretty good mix here. And of you who are operators, are any of you already C corporations? Many of you-ish. Okay. And are any of you holding on to the concept, I want to be a flow-through for better tax reasons? Any LLCs or S-Corps? Okay, a little bit. All right. Well, I think when we talk about 1202 stock, I think there's a couple personas that are pertinent to this group. You guys, this is deep water. And as I was thinking about why I think this topic is a little tricky, to me it's because some of the definitions, as I read it in the code, depend on your situation. You get a different result out of that definition. You take a founder, okay, founder of a C corporation with founder shares, 0 tax basis in that stock. That founder selling those C Corp shares after holding it 5 years originally issued shares stands to have an exemption of $10 million. But it's going to be tricky for that founder to get better than $10 million. And we'll try to shed some light on that today. Now, I will say if that founder's married, they're going to be able to double that exemption.
Maybe double it.
Maybe. But we're also not bringing back plural marriage to try to exploit that opportunity here. So maybe a double exemption is what you're getting, right? Okay, so if you're a founder, I think where you should come to this moment, and in a minute I'm going to introduce Adam Sweet, I think you should come to this moment thinking C Corp founder from the start, I could get a 10 million exemption when I sell that stock, maybe times 2. Perhaps tax-free. We're accountants. You gotta talk to your CPA before I'm willing to say tax-free, right? Okay, so that's the C Corp founder. Now, what I'm gonna call a late-comer investor. So someone who comes in with cash. This late-comer investor, we've already got a little momentum. I'm putting cash or maybe property to invest. Now I have the ceiling is gonna come off for me. As long as that company has a gross asset value below 50 million, because I'm in early enough in the value game, now I'm going to get the 10 million at least, but I could also get 10x my investment as an exemption. Call it tax-free, okay? So that's the latecomer investor. The founder, not so much. Okay, so the founder's sitting back here at 10 million, maybe 20 million. But for the investor, now it gets very interesting. And I think there's some planning to do here, making sure we're under that $50 million cap. I would asterisk that and say that I think, a founder can also be an investor. There's a path there, but for clarity, I think those are your two personas. Then I think the third persona that exists in this room is the LLC, started as an LLC, could be S Corp actually, flow through. And now I'm going to make a play, as my client has done this summer. I'm going to flip the switch, become a C corporation. As I contribute assets into this C corporation, I've got a tax basis. My gross asset value is now fair market value on the day that I contribute. As long as I'm under 50 million, I can 10x that value for my exemption. For stockholders, original issue stockholders who are going to hold it 5 years in this C Corp born today. Okay, so as you go around, you're at cocktail parties, wanting to look cool. CPAs don't get invited to cocktail parties, but if we do, we tell stories about 1202 stock. So I think these are your three kind of personas. A $10 million founder, you've got an investor that could 10x his or her investment, and then you've got an LLC conversion that could 10x an investment, and because they're contributing appreciated property, because their business has been rolling a little bit, that starts to get a little interesting. That's the frame to put on for today, okay? So, as Chris said, my name is Josh Rowley. So I'm a partner at Eide Bailly, tax partner here in Lehigh, Utah. One of my roles in the firm is to head up our technology industry group for software companies. And when the water gets deep like it does today, I call Adam Sweet. So Adam is a principal in our national tax office. I love practicing tax accounting when I can call Adam Sweet and say, Adam, fill in the corners, check me on this. And so he's here today. This is the man with the plan in demand. He's going to be on a plane. He came in from Spokane this morning as he's going out to Vegas tonight to speak at another conference tomorrow. So grateful to have him here. Adam Sweet really would call himself a partnership guy, but along the way, he started answering the phone when it was ringing, talking about 1202. So he has developed quite a facility with 1202 stock. And so if you would just welcome him, we'll give it over to Adam to talk about the details.
Thank you, Josh. This is on, right? Yeah. So Josh, just real quick, I sit in Spokane, but I'm part of our national tax office. And all that really means is I'm kind of a resource to our firm for a whole bunch of different stuff. And then one of my areas is 1202 stock. Now, I do kind of cringe when people say I'm an expert, because when someone else tells me they're an expert at something, my first thought is, you're not an expert if you say you're an expert. So I would just say, knowledgeable 1202 persona. So, yeah, so as Josh, maybe just start with the basics. Why do we care about 1202? Well, potentially you can exclude, so I think someone said tax-free. We use the term exclusion, but you can exclude up to $500 million of taxable gain. So in a perfect world, if you designed a perfect 1202 situation, perfect 1202 company, and you did everything perfect, including an exit, you could exclude up to $500 million. Now that's in total, right? That would be all your shareholders combined, but that's always the big number that catches people's eye. You know, it's the smallest amount. It's the greater of 10 million or 10 times your basis. Basis is typically how much has been invested, and you can invest a maximum of $50 million. So 10 times 50 would be 500 million. So that's why, if nothing else, if you said, I don't really care about anything else, why should I care? That would be why most people are caring about QSBS. It's been around since 1993, this code provision, not indexed for inflation, like a lot of things. So that number, this 10 times and 500 million existed in 93, and it's still the same number today in 2024.
And I would just say, we're not going to get into it today, but there is a path. Some commentators on 1202 stock would say that founders could take their $10 million exemption and, in some cases, a 10 times basis if they're investing, wearing two hats, two positions in their stock. So if that's something that we should talk about, we won't be doing it today, but there's some interesting ways to open that up.
Yeah, good point. So this is kind of our agenda for the day. And I'd say just please do raise if you have a question, please raise it as we go. Lets me know that people are listening, and I've also found that if you have a question, typically other people have that same question, so happy to take it as we go. But kind of our agenda for the day, focusing first on how do you get QSBS? Second, once you have QSBS, how do you keep QSBS, which is operating as a qualified corporation? You know, what are the things to think about when it comes time to exit? We say exit. Exit really means fancy word for selling. And then finally, if we have time, kind of miscellaneous other considerations, traps for the unwary, common fact patterns we've seen in our practice. So the first thing is, how do you get QSBS? And the term is original issuance. And the big point is there's two main ways to get QSBS. You can get, and QSBS is qualified small business stock, if I didn't say that. But you can get it in exchange for a capital contribution. So capital contribution would be you take money or property, contribute it to a corporation, and you get stock back. You can also get QSBS for services rendered. So you talked about the founder or key employees. That's often the way they're going to get QSBS, is they're not bringing cash to the table necessarily, but they're going to have a stock grant for services. So that can also be QSBS. But the last bullet is the big point. You cannot buy QSBS on the secondary market. So via cross-purchase, for instance. We run into this all the time, where someone forms a company, got good QSBS, Josh comes in and buys their stock. Instantly, that is no longer QSBS in the hands of Josh. Yeah.
So I know we're at Silicon Slopes. My company's not a SaaS company. Is there any difference?
No, so what we're talking, and we'll get into it, really, 1202 starts with you need to be a C corporation. So we kind of tailored this a bit to SaaS, but most of this is going to be relevant to any company. So good question.
Yeah, and I would say along the way in this presentation, I think you'll see we've got a picture of a needle being threaded here, because to set up for this is really threading a needle. We'll get into certain businesses are excluded, but it works well for SaaS, because SaaS is the place where you might want to be a C corporation. Because if I'm setting up for institutional money, and so you saw it when we had the hand raise here, most of the operators here are already operating as a C corporation. That would not be the case in other industries. So it fits uniquely for SaaS.
But you're going to talk about trust work.
We will, yeah. So we'll get into that. Yeah, it's maybe not as deep as you want, but we'll talk about it. Yeah.
So you mentioned that your entity has recently done this, where they went from an LLC or LLP to a C corp. But I thought one of the exclusions.
Well, to be specific, yeah, to be specific, Josh has a client that did it. Ide Bailey has not done this. Yeah, to be specific, Josh was saying Josh has had a client that operated as an LLC. They were otherwise LLC. That's right.
You
That's right.
You're we have a slide in a couple slides, but it'd be nice if we did, but we're not eligible. So yeah, the big point, you can't purchase QSBS. So no cross purchase. Other ways to acquire QSBS, there are 3 other ways you can acquire QSBS. Someone asked the trust question, and that where you can gift QSBS, and the recipient of the gift steps into the shoes. So if I acquire good QSBS, I can gift it, and whoever I gift it to, they step into my shoes for QSBS purposes.
So the clock, starting clock is the same. The basis is the same.
Correct. That's right. So that's a major planning point. We have a slide coming up, but a big planning point there. You can also you can inherit QSBS. So again, at death, your estate could step into your shoes. And then this is maybe beyond today's presentation, but a partnership that holds QSBS. Under certain circumstances, that partnership can distribute out QSBS to a partner, and that partner can continue to hold QSBS. There's a whole bunch of requirements. It's not as simple as it sounds, but potentially that can work. So this also shows, so you can acquire QSBS directly, which is probably what a lot of your founder companies have set up. The other very common thing we see, especially if you have private equity involved, so private equity, venture capital, they're going to often have a fund structure. And the triangle here is a fund. So they're going to have a partnership structure somewhere along the line. So they're not going to have, if I'm private equity, I'm going to attract my own investors into my vehicle, whatever my vehicle is, typically an LLC, and then my fund then will take those dollars and put it into your QSBS. And this just shows that works as well. You can invest into a partnership. The partnership can invest into QSBS, and the partners, so the investors in this slide, can also be eligible for the gain exclusion. They're treated as basically indirectly acquiring the QSBS through the partnership. So we see this a lot. You're not going to see it if it's Josh and Adam starting up a company. We're not going to have this structure. But if you're going out to market to raise money, and private equity, VC, some other type of structures coming in, they're going to invest typically through a partnership, and they can. The important point here is they can still get QSBS even though they're investing through the partnership. So that's kind of the basics of original issuance. To kind of the next question is, so you got a C corp, you acquire stock at original issuance. Are you good to go? And the answer is maybe, and maybe not. You have to have what's called a qualified business for 1202 purposes. And this is kind of an old joke, but you would think they would. Do you think the statute tells you what a qualified business is? So all the statute does is tell you what a qualified business is not. So it's defined by exclusion, which maybe is good in a way, but it's always interesting when they choose to do that. They say you need to be qualified, they being Congress, say you need to be qualified, and you're like, well, great, I want to be qualified. I think that sounds good to be qualified. And you say, well, what's it take to be qualified? They don't tell you. They just tell you what it takes to be non-qualified. So these are the often abused industries, these are the industries where we pay the most amount of tax. We don't get any of the breaks, right?
Because we're on that list.
We're on that list,
as
right?
was pointed out.
The lawyers, the accountants, the doctors, the consultants. There's a whole variety of code provisions that don't give us necessarily the benefits that other people can receive. You can tell I'm a partner at an accounting firm, so you don't have to. Don't be too sad for me. But none of those businesses qualify for 1202 purposes. So the question was, Eide Bailly, we're a partnership. We cannot choose to be a C corp and be a QSB because we're an accounting firm.
Plus, after 100 years, the ownership that I bought is not originally issued ownership, right? So I'm disqualified all over the place. Yeah. As an accounting firm, doesn't work.
So many of these categories are self-explanatory, right? Banking, finance, accounting firm, lawyers, doctors. There are a couple of categories that are kind of perennial, gray areas or give us pause. And one area is consulting services, and just exactly what it means to be involved in consulting services. And the reason why we actually worry about this is if more than 20% of your assets are a bad asset, so they come from one of these business lines, the whole company is a bad company for 1202 purposes. So if you have a company and 30% of the company is law services, then the whole company is not a qualified company.
And Adam, I would say this is significant, and for this group, I mean, we live in a world of kind of tech-enabled services, and I think tech-enabled services are going to bump their heads here. I was having a conversation with a client who's here, and we put the pencil down at this moment for their possibility of converting to a C corporation, because we said, you know, you've been a consulting company that you're moving to tech. We've developed software now, and that's how we deploy. And we've got a recurring revenue model. And so that is driving value. But how much are we still doing that's consultative that would be considered service-based? Now, I will say in the SaaS space, I think you have the wind at your back when you do this math because of the multiples that you get on the tech, on that ARR. You get a nice multiple there. So if your value's been driven there, maybe the value left behind, maybe it's a 1x multiple of revenue for services. Maybe you can still get there. So I wouldn't totally walk away from it, but know that there's a threshold here to deal with.
It's something to be aware. A question, yeah.
Looking at you're charging by the hour, if you have like a government contract or government grant, does that qualify as services?
So we don't have any definition of consulting services for 1202, but what I highlighted here, there are other code provisions that define consulting services, not binding for 1202 purposes, but maybe relevant. And two of the factors that the IRS often points to is consultants charge by the hour, and then consultants also customize their product for a particular customer. So I always say the more off the shelf something is, the less that looks like consulting. The more that you're going in to study a particular client situation, and it's a software package, and you're tailoring that package for that client, that looks more like consulting perhaps. And then also charge by the hour. Like Eide Bailly, we charge by the hour, right? Whether it's, I mean, hopefully it's a successful project, but at the end of the day, we charge by the hour, which is kind of a hallmark of consultants, versus if you charge only upon the completion of a project or the successful completion of a project, maybe that's less like consulting. Who knows? Like, these aren't factors for 1202 exactly, but these are factors in other areas of the code that talk about consulting services. This is what people look to. So, yeah.
You mentioned 20% is like this area. And then first you said sales, and then you said value. Those are two different things. So if 20% of my sales come from, or more than 20% come from some disqualifying thing, like an hourly charge thing, as opposed to when I go to sell my business, I may get 7 to 24x on my tech, and I might get 1 to 2x on my consulting arm that enables this tech or customize it or whatever. In terms of the ratio there, it would be less than 20%, but it could be more in terms of the value of the company, but it could be more than 20% in terms of the revenue.
Yeah, so
So where's your mark?
well, the hiccup is the statute says, technically the statute says more than 80% of the assets need to be used in a qualified trader business. So then what is an asset? Like in a service company, what's an asset? We often look to revenue as a proxy, but who knows, right? Who knows ultimately? To Josh,
People
yeah.
the other side is
It's a good point. My argument, Robert, would be that the assets of a tech company, now, and this was an argument to make, the assets of a tech company, it's not the laptops floating around, you know, an empty warehouse. It's the recurring revenue, the recurring revenue and the IP. Yeah. So, would it float? I guess who wants to be first to test it?
It's also, there's also guidance out there that says that if your primary purpose is selling a product and you have embedded services as part of that, that is not consulting services. So if you're selling widgets or you're selling whatever it is, and part of it is you send Josh out to implement the widget, maybe that's not consulting services, because what you're really doing is you're selling widgets. Sure, Josh maybe helps you plug it into your systems, but I'm not selling Josh, I'm selling the widgets. Josh is just kind of complementary to that.
One of the keys, I think, on the slide previous is anything is disqualified that relies on the reputation or skill of the employees. I think that's directive language.
Did I see a hand raised? Yeah. Yeah. I will say it's very bright in our eyes, so it's hard to see, but I saw a hand.
The position then that like we're looking at fair market value as a proxy for intangible assets,
Indeed. So yes. So you can get, if you're ever uncertain, the IRS will you pay money, and it takes a long time. It's called a private letter ruling, but you can kind of disclose full cards to the IRS about what your business is and what you do. And the IRS will issue you a ruling saying you have a qualified business or you don't have a qualified business. And we did a PLR, it's actually pre-COVID, where that's where they look to revenue. It was basically a business with no fixed assets, right? We can't point to tangible assets. We knew that a portion of the business was bad, and we argued, well, the revenue from the bad business is under 20%, and the IRS went for that. That is, well, that's...
It's a scale. Private letter rulings, depending on the topic, is a scale. But I've seen one for $3,500, and I've seen one for $30,000.
This one would be it's a $38,000 filing fee plus our time.
Size of the company or revenue of the company, or just what you're asking for?
What you're asking for, and it's a fee to the IRS.
Yeah, they're expensive. So you're going to do it. You're going to only do it when you have big dollars. Yeah. Yeah. And that didn't include the filing fee, probably. Yeah. But to be truthful, a lot of us, we wouldn't be 75 grand, but it's an expensive process to go through. So, but you get a high degree of certainty from it, right? You're getting the IRS blessing what you're doing. So if it's enough money on the table, right, if it's $100 million, then that may be worth it to go for it.
I'm reminded, because they're streaming and recording, we love the discussion. We'll do our best to get a mic in front of you, or I'll try to repeat your questions, so keep going.
Yeah. So then, we're moving quickly through all of this, but another component to being a good QSB is at the time you issue stock, your gross asset value is under $50 million. So that's another defining feature. I would just say people get alarmed by that number because you may have done like a fundraising round where you valued your company to $100 million. Maybe someone came in and got 10% of your company for $10 million, and you back into the math that says I'm worth $100 million. That doesn't mean you're not a good 1202 company, because there's a very specific definition. For 1202 purposes, the $50 million test, there's a very specific definition. And it's not necessarily fair market value. Generally speaking, the $50 million test is going to be tax basis of your assets. So if you're a software company and you have self-created intangible, there's no tax basis. It could be worth $1 billion, but the tax basis may be minimal, and so you could still be under the $50 million 1202 threshold. So I just say we have calls with clients all the time. I mention $50 million, and they instantly are like, oh, we don't qualify. And I say, well, why don't you qualify? Because we just had our latest fundraising round, and we valued ourselves at $60 million. And maybe that could be a problem, or it could not be a problem. It really depends on what's on the balance sheet. And the more that's on the balance sheet that's really with no tax basis, then it's not an issue for 1202 necessarily. Yeah.
So you're talking about R&D that's sitting on your balance sheet.
Yeah, I mean, so yeah, typical. But for a software company, that's going to be a pretty bare bones balance sheet typically. You're not going to see, I'm talking about a tax balance. Like a balance sheet, like for our client, manufacturing client, right? They're going to have millions of dollars of equipment sitting on their balance sheet. Right? Our real estate client, they own a $50 million building. That's a $50 million asset on their balance sheet. Software company, or I guess, just in the tech industry, there's very valuable assets, but they're intangible assets.
Which is another reason why this fits so well with SaaS, is because the chance of us staying under 50 million is good. I will say there's an interesting thing in the market right now. If you're SaaS, you'd know you've been having to capitalize your R&D costs for the last couple years. And that's, Robert, what you're hitting at. Yeah, that means you've got tax basis sitting on the balance sheet. So now you have undepreciated laptops and capitalized R&D costs. Prior to 2022, you could depreciate all your development activities. Even though GAAP says you capitalize those in a certain way as an asset, but tax has always let you depreciate those, so you have no tax basis there. But now we have tax basis sitting on our tax basis balance sheet. So I think that's a good point to make. And there's some ways that you can play with that, right? Because your 10x is going to key off that tax basis number, and maybe it's going to be in your favor.
I'd also say the $50 million number is gross, so liabilities are not netted. So this is kind of just a quick example that we put together here, but you have 10 million of cash, 5 million of operating cash on the balance sheet, 40 million of self-created IP, and then liabilities. And for 1202 purposes, that equates to a $15 million gross asset value. So we don't net the liabilities, and we're ignoring that intangible asset because there's no basis to that intangible asset.
To me, this is one of the tricky bits of qualified small business stock, is just getting your head around this, because I don't know of very many other measures where you think about your value of your company this way. You've got three concepts at play: fair market value, tax basis, gross asset value. And so this is our attempt to try to help you sort that out as you think about this.
And we have slides coming up, but the one disclaimer on this is if you have any kind of merger transaction or any kind of conversion transaction, that can cause assets to be valued at fair market value for 1202 purposes. So if you're just a startup, you've done nothing, you started a C Corp, no mergers, no conversions, no anything, this math is going to hold. If you did a startup and you merged with another company, or to Josh's fact pattern, you were a partnership and you converted, this math is not going to hold because you'll have to value. Typically, then the intangibles are going to be valued at fair market value for 1202
Yeah,
purposes.
so to connect that up with the front, what I said at the front, these three personas, it's this guy over here, these LLCs converting your 10x of everything in the dark blue, right, on that value at fair market value. Again, still not liabilities.
Yeah.
Which can really platform your 10x.
Okay, but you're still only talking about future grants, not original grants. If you qualified in the original grant, that stays for friggin' ever.
Yes.
The measurement is
Yes.
just before and just after. The $50 million test matters for just before stock issuance and immediately after. So as long as you're in, so if I'm a founder and at some point later on $50 million is crossed, that only affects new money coming in. I'm grandfathered in, correct. So these are a couple other, we're going to talk, we have some slides, but just other things to think about, just to be careful of. Redemption transactions, I think someone was talking about that with me before we started. Be careful with redemptions. Redemptions can jeopardize some people. They can actually jeopardize everyone if you redeem out a shareholder around an issuance. If you have different lines of businesses and some are operating and some are non-operating, like investment activity, for instance, that can create problems. And then again, we talked about it there, but if you have assets over 50 million, one of the gating questions I usually ask for 50 million is how much cash. If you tell me no mergers, no redemptions, no conversions, we've been just a C Corp from the beginning, one thing I ask is how much money have you raised in total? And if you tell me $6 million, pretty sure you're going to be under $50 million. If you tell me we've raised $70 million, then instantly, right, alarm bells are going off. You may have more than $50 million of assets on the balance sheet. That's not perfect math, but that's kind of one of the first things I ask if someone asks the question.
And I would just point out, for those of you that are in that space, to raise more than $50 million, there's some cash flow planning, because it just needs to not be sitting as cash in the bank, right? So at any time, if you raise 50 million and that all drops in the bank, you just tripped your tripwire. But if you bring it in as you need it, spend it down. Remember, you're spending it and deducting it for tax purposes probably, right? So now you're bringing it in and you're not rising above that $50 million mark.
But the redemptions only disqualify a year forward and a year back, right? They can happen in the middle?
There's two different redemption transactions. I mean, it's beyond today's, but there's two different types of redemption transaction. One of them looks back 2 years and forward 2 years. The other one looks back 1 year and forward 1 year. But just all I tell a client is just be careful. If you're going to do a redemption, talk to us or talk to someone first before you do it, because it could be okay, but we've seen it before where people are exiting. They think they have good QSBS, and it finds out 3 years ago the classic fact pattern is this, that Josh and I are founders. We used to get along really well. Josh is a difficult person, so now I just like Josh.
It's not a fact pattern.
I want to get away from you. And we attract new money, right? New money comes in, and I'm like, you know what, guys? I just want my cash. I want out. Redeem me out. So new money comes in, and they get an issuance of stock, and they think they have QSBS. I'm gone because I don't want to work with Josh, or we should change it, right? Josh doesn't want to work with me, so Josh is gone. That redemption, depending on the values involved, can jeopardize the actual new money that, even if the new money isn't related to me at all, I'm using that cash to be redeemed out. It can jeopardize the issuance. Yeah.
Okay, now there's a way around this whole thing. And let me explain what we did, because we started a C Corp, and C Corp startup docs talk about repurchase rights. Something triggers, and all of a sudden we have to buy, or for $1, all of this stock, which would then invalidate any grant going back a year or a year forward. I don't know about the 2-year thing. That's interesting. But what we did instead was we said that we follow a formula, like a vesting formula. So maybe it's a 1-year cliff and then monthly for the next 2 years for a 3-year total. But it's a forfeiture. So the stock doesn't get repurchased. It disappears, like it's canceled, like it never existed. That will never trigger that redemption issue. Floats people up a little bit, but then you issue more stock, supposedly to get the new person that left, a replacement, and it comes back down. Probably not as much. That's a very significant issue, and you better address those in your startup docs so that you don't have the typical problems of we have to buy your stock, which a lot of docs have that, or this whole vesting thing where until you actually own the stock, that 5-year thing doesn't even start. So if you're thinking LLC, it's not started. When you convert to C, it starts. And so there you go. That's my input on that.
Yeah. Okay, so then, exits, right? That's everyone's favorite topic, right? Ultimately, the whole goal with all of this is get QSBS, operate as a qualified company, and sell tax-free. So what are the basics of exiting? Well, the basics are you need to hold, as long as QSBS was issued after 2010, there's different rules for stock issued before 2010. There's actually a 75% exclusion and then a 50% exclusion that are a lot less generous, and we won't go into that. But as long as your stock was issued after 2010 and you've held it for at least 5 years and the company did everything it was supposed to do, you can then sell that stock and exclude 100% of the gain up to 10 million or 10 times your basis. And true exclusion, right, for all purposes, not every state qualifies, but for federal purposes, it's truly excluded. It's not subject to AMT. There's no add backs, no anything. You just don't pay tax.
Utah conforms. California does not. I think that's what's pertinent to this group, right? Because if you're doing tech, California seems to be the first state you start filing in. I got to tell a quick story here, just because I'm the guy that swings a hammer. This is the guy that does the blueprints. So my first blush with 1202 stock early in my career, I had a client. They were actually just honored in the Mountain West Capital 100. They're still around. But early in my career, he came back to me. I don't think I did the original return. Maybe I did. He's like, we got to amend a return. I said, why? What's going on? He said, I think I have this qualified stock. I get an exclusion. So because the qualification happens at the entity level, if there's not good communication, stockholders don't know. And it's the 1040, it's the individual tax return where that guy walking into a TurboTax interview or an interview with a CPA doesn't have a K1 or anything else to say this is qualified small business stock. There is nothing to tell TurboTax or the CPA that that's what's happening. And I will tell you, I'm aware of a story where that realization came after the 3-year statute of limitation, gone. The taxpayer didn't take advantage of the exclusion. So this is my sideline here to say, best practice in this space for you who are CFOs is some kind of a communication to your shareholders so that they're aware of the stock at issuance, what they're getting.
So then another planning, we're talking about exits, so a planning idea is, and someone had asked earlier about gifting to a trust. So if you remember, one of the ways you can transfer QSBS is via gift. And there's an idea out there called stacking is the term. If you Google it, you'll find a bunch of articles about stacking QSBS. And we kind of have a simple fact pattern here that shows how that might work. That you have a founder that acquired stock for $1 million. I mean, you could call it zero, really, for purposes of this fact pattern. So we know that the maximum they can exclude is 10 times their basis, which would be $11 million. And they're going to sell their stock for $20 million. So that means 9 million of that gain is going to be taxed because they can only exclude 10 times their basis. Their basis is $1 million, so 9 million would be taxed. At some time before the sale, really hopefully at some time before there's an LOI, at some time before you've gone to market to sell your company, founder could consider gifting half their stock to a child. Child would step into the shoes of founder, and child could separately then, if there was a sale, separately claim their own the greater of 10 million or 10 times their basis. So if that same stock then was sold so that child sells $10 million worth, founder sells $10 million worth, in aggregate they'd pay zero amount of tax because you've stacked that 10-time multiple with a child. You need, a couple, I'll get to questions, but just a couple of big points. You need a completed gift for tax purposes, which is harder than it sounds. So revocable trust, that doesn't work. Often people want to do this on the 1 yard line right before a sale. That doesn't work. The IRS is pretty successful at clawing that back, that if you're going to gift something to a child right before you sell it, the IRS says, no, you were the owner of that, and what you really did was sell it and then gifted the cash afterwards. So really, before you have an LOI, hopefully even before you've gone to market to sell, that in a perfect world, that's when you do your gifting. So.
And because you've got a $26 million gifting exclusion, I think you also need to do it before your values are screaming high, too.
That's right. And I'm always the income.
For a gift to a child, spouse, not the same way.
And I'm the income tax person, not the estate. So that's, there's separate things to think about, too. For estate plans, don't let my income tax ideas throw off your estate planning. So all kinds of things to think about there. But this is the basics of stacking. People do this. There's people out there that have set up 5 different irrevocable trusts and gifted, so they're going to have a big multiple, and they've gifted stock into 5 different trusts to exclude, whatever that math is, 50 million of, and potentially it worked. The statute says it works. So I've never seen an audit. I've seen people do it, never seen an audit, but very popular planning idea. Yeah. So the question was how far in advance, and so this is who knows, as far in advance as possible. So that's a good lawyer answer, right? So
you heard Adam say certainly pre-signed LOI.
I would say
I think is best practice.
Yeah. LOI is a red line for us. I would say even LOI, I think that's pretty hard because I think there's court cases you can find where post LOI, the IRS is able to claw that back. This comes up too in the charitable gift area where you're going to sell stock in a company and you want to gift a portion of it first to a charity because the charity could then sell it. And you can get a fair market value donation. They don't have to pay the tax. Charity sells the stock. So there too, the dividing line is, did you gift it before the LOI? And so we think similar principles would apply. Yeah.
But one way to think about this is what's the gift tax limit? Is it 13 million, 14 million per individual, 28 per couple?
Right.
So it's before it gets to $28 million.
And it's hard because people don't want to give up control. A true gift is you're giving up control. So it's a dance, right? No founder is going to do this early on because they want to have control. And we always like to think that everyone likes their children, but we found even sometimes people don't necessarily want to give something to their kids until the last second. So it's more complicated, right? Than there's not from a tax standpoint, but just from the economics or control or other things going on. And usually people want to wait for as long as possible. They want to keep control until the last possible second and then gift. And then that's kind of at odds with what we're saying is it'd really be better to gift as early as you can. So what do you do? We run into this too. You have to hold stock for 5 years. What happens if you sell? You have good QSBS at original issuance. The company's been doing all the right things, but you have an offer that's just too good to be true at year 4, and you have to take the offer. So what can you do? So there's a code provision called 1045 that says you can roll over the gain. You can sell QSBS, and you can reinvest that gain within, did I put the time? 60 days. 60 days into other QSBS, and you can tack the holding period. So you could hold QSBS for 4 years, someone comes in and buys it from you. You take that gain, you reinvest it into a new QSBS, you hold that for an additional year, you could then sell that, and you'd have your 5-year exclusion. So that's in this isn't aggressive planning. There's a code provision that says you can do exactly this. And we see this sometimes.
I think what's tricky about this is you might be getting rollover shares in your sale, but is that, that buyer, are they under the $50 million gross asset value test? So I think this is a tricky one. But worst case scenario here is what? If you've held it for a year, long-term capital gain on stock, I think you're still going to high five all the way around the table there.
Yeah.
Still here now, but that's our worst case scenario is capital gain.
It's also possible, that second point, if there's any kind of merger transaction, there's rules that say you can exchange QSBS for other QSBS as part of a merger, and you can tack your holding period. It's again, like everything, it's a little more complicated than that, but it's possible to if you have one QSBS and it's going to acquire another QSBS, and it's a stock for stock transaction, it's possible that all shareholders at the end could still end up holding QSBS, even though they've exchanged their original stock for stock in the new company. What do we got? Yeah, so we talked. Oh, question. Yeah.
So if you're acquired by a public company, is there any way to transfer stock?
So no, but there's a rule that says if you have good QSBS and you exchange it for non-QSBS, which would be public stock, the gain that would embed it at the time that you exchanged it, if that was 1202 eligible, when you then sell that 1202 stock, you could exclude that amount of gain. So let's just say I've held my stock for 5 years. There's $100 of 1202 gain embedded in that stock, and I'm acquired by a public company, and I get that public stock in exchange, and we know the public stock is not QSBS. I then sell that public stock for $150 later on. 100 of the gain could be excluded because that 100 was embedded in the stock before I converted it to non-qualified stock.
And if
I
you'd
know
only held the stock,
that's a mouthful. Does that make sense?
yeah,
though?
but if you only held the stock for 3 years, are you able to continue?
So so then you may be, because that rule doesn't apply. I think that you may be out of luck there.
You can't hold public stock for an extra 2 years?
No, there's a rule in 1202 that says I think if you've held the stock for 5 years, the gain eligible remains eligible, even though the new stock you hold isn't eligible. But I don't know whether, I'd have to confirm. I'm not sure whether that same rule applies. I follow you. Basically, you're wondering if that rollover piece, could you roll it over into non-qualified stock?
Exactly.
I'd have to confirm. I don't know that.
Okay.
Good question.
So not an expert after all.
I told you, the moment anyone tells you they're an expert on anything,
Stop believing them.
your radar should go up, and my radar goes up, especially in the tax world.
It's called the practice of
The
accounting.
moment I'm on a call and someone tells me they're an expert on something, that's the moment that I start to listen extra carefully. Yeah, redemptions, be very careful with redemptions. I think we talked about that. Anytime you're going to do any type of merger or reorganization transaction, just take a pause. If you have QSBS or you're operating a QSB company, just take a time out and go talk to your tax advisor before you do it, because there may be ways to do it and preserve QSBS. And there's definitely ways to do it and jeopardize your QSBS. So always better, I tell everyone that's planning into this, hey, if you're going to do anything material, then come back to us and talk, and let's think through it and make sure that we don't blow this up unnecessarily. Yeah, question.
I just want to clarify. I think you may have clarified this, but if someone an investor puts in money early, another investor comes in and does a private transaction to buy that person's stock, obviously the new investor who's buying their stock, that's not QSBS eligible, but that doesn't impact the rest of the companies for QSBS, does it?
Correct. So the question was, if I purchase stock via, I call it a cross purchase, but secondary transaction, right? So if I buy stock from a founder, not QSBS for me, it does not jeopardize anyone else. Everyone else's stock,
Unless the company has a right of first refusal and they exercise it, which causes a redemption, which would disqualify.
yeah, if there's if there's a redemption associated with it,
Buys back the stock, that creates
that's a problem.
you have to do the test,
And I've seen the and I keep talking about the redemption. So yeah, exactly right. As long
Just
as it's
have
a
to-
cross purchase.
Yeah. Okay. Great. I had that happen. I just want to make sure. In fact, I'm pretty sure we called you. So
Okay.
I think you already
Is that,
told
is
us
that the
this.
answer I gave you, or did
Yeah.
did I?
That was the answer.
Always good if I'm consistent with my
I wanted to
answers.
make sure the answer hadn't changed. So
Would you have been concerned if I said, "Oh, that's a big no-no"? If I if I said. But the redemption piece, I've said it 3 different times. The only reason why I've seen it many times where people are exiting, and there was a redemption transaction 4 years ago that blows up everything. And the quote is, "Why did no one tell us?" And I'm like, I don't know. I wasn't there 4 years ago, so just careful with that. State conformity, we mentioned, we think from a federal income tax perspective. Not all states conform to 1202. Utah does conform. Josh points out California does not conform, and California is a material. If you're a California resident, that's a material number for California purposes. Other considerations. So this goes to my real area of expertise is flow-through entities. I'm not really a C corporation person, and I typically all day long I extol the benefits of flow-through entities because I think partnerships and S corporations, really partnerships in particular, are kind of a superior tax beast, if you want to say. You can get a lot more benefits from an LLC than you can a C corp as an owner. So I always tell clients to think carefully. 1202. Think of what 1202 requires. Requires you to have a good business, acquire your stock at original issuance, hold your stock for 5 years, and most importantly, it requires you to have a buyer who's willing to do what? Buy C Corp stock. And I can tell you a lot of buyers out there do not want to own C Corp stock. This has been a very hot market for private equity acquisitions of like HVAC businesses. I don't know if you've read about it. Like this is an example, right? Mid-market companies, right? Vet clinics, HVAC companies.
All those service and tech
Yeah.
tech enable, and they want that recurring revenue.
All
Yeah.
these private equities are coming in and rolling up these businesses. And we have clients that operate in a variety of forms. These transactions 100% of the time are asset transactions for tax purposes, not stock transactions. Private equity is going to say, if you say, hey, I got a C Corp, I want 1202, they're going to say, that's nice, but do you want the cash or not want the cash?
I think this is meaningful, but before I
Yeah.
make my comment, can we get a mic up here?
Venture money or even sophisticated angel money, you have to be a C corp. You can't do that as an LLC.
The point is, yeah, but you're probably a C Corp for other reasons, or perhaps for other reasons. And so maybe it's not because you're, going after qualified small business stock disposition. True, I would agree. So I talk to our transaction advisory people and I say, hey, as a guy sitting at a tax desk, for 20 plus years, that's what I see is asset sales. So why would we ever even try to set up for a stock sale? Because you can do all these things and maybe take the disadvantages of running as a C corporation. Maybe you have to, but why would you do it? And I will say, what I hear from them is times are changing, right? With the 100% exemption, I think there are buyers who understand we want this deal to go. And again, not so much in the HVAC world, but who's buying your SaaS company? They're not buying it for a step up and a deduction. They're buying it to flip it. And even if they got a step up and a deduction on an asset purchase, they'd be amortizing that step up, what they spend over 15 years. It's not why they're at the table with you. So suddenly, I think there is space here for a C corporation stock sale with a strategic buyer that's going to flip. And Chris, can we get a mic in the front row here? The other thing I'll mention is the mic travels up. The other thing that I hear is there are perhaps ways to embed into the value of your corporation an appetite by the buyer that they want to own corporate stock. So the best example is government contracts. If you've got government contracts or any other contract that a buyer is not going to want to greenfield a new entity, or they do not have the facility to hold those contracts in their entity, they don't want to have to renegotiate things. They want to buy your stock. So I think there's some cases there as well.
Just be careful because there's a way to, there's ways to do that and still get the there's ways to do all that and still get the asset step up. Private equity is very smart, so there's
Yes.
ways to.
Yes.
But yeah.
So my experience, I'm in the M&A space, M&A advisor. And my experience, kind of a rule of thumb, if they're sub 30 million, so under 30 million, they prefer the flow-through entities. Once you get over about 30 million, then they like the C corps with what they're
To
doing.
acquire.
Yeah, to acquire.
They're willing to acquire the stock.
Yep, exactly. And I'm seeing that C corps are sold. In fact, I've got a few for sale right now, but they're typically at a discount. You're looking at a 20 or 30% discount and selling a C corp if the company is less than 30 million. That's just kind of rule of thumb, kind of benchmark for you.
And the reason why he brought up the discount, the reason why is you can present value the tax benefit of the step up. And then if you're the buyer, you're like, hey, the step up is worth X amount of dollars over 15 years. I'm going to present value that, and that's going to be the haircut if you want me to buy your stock. And that really cuts into then the 1202 benefit, right? If you're going to have to sell your 1202 stock, but you're going to have to sell it at a discount, well, the gain exclusion is a lot less powerful. And that's it. One other thing is it depends, too, on if you're going to be profitable, flow-through entities are way more efficient from a tax perspective. Now, if you're going to have losses, different consideration. And this slide's a pretty simple slide. But right now, there's about a 9-point spread. If you're a C Corp and you want to pay out your earnings, you're going to pay about a 40% effective tax rate. So that's going to be corporate level tax plus the dividend rate. Flow-through entity is going to pay about a 29 or 30% tax rate, pay out its earnings. Now, this is simplified, right? This is if you only paid out half your earnings, the math would look differently. But there's a reason why most of our clients are organized as tax partnerships or S corps, because it's just way more efficient from a tax perspective. It's very expensive. If you're C corp and profitable, it's very expensive to pull your earnings out because there's no. You either pull it out as a wage, which is expensive, or you pull it out as a dividend, which is expensive. So now, if you're going to have losses. And you might say, hey, LLC would be great for losses because you pass out the losses, but maybe your investors are passive and they don't care about the losses, which happens quite a bit.
Well, this, Rob, is why it's remarkable to me. That someone would make that switch. But my client that did this switch this year, they're planning on not running profitable anymore. They're going to take some cash. They're in it for 5 years. Set the 5-year clock, convert to C. They've got a 10x of the fair market value that becomes that C on the first day. And they're going to tolerate some measure of differential here because they're pretty bullish on what they're going to get after 5 years.
Well, another issue is that you don't have to declare a distribution. You can play for the end game. That's the exit. It's not trying to take stuff along the way. You reinvest and build the thing that gets you your big exit. And then you only have your smaller tax rate, so that whole flow-through thing.
I think what you're saying is, like, if you're an LLC, are you stepping over, dollars to pick up pennies, right? Because
I'm saying go C.
Yes.
And you have a tax rate that's lower, and don't do distributions. Except for now, we don't know what's going to happen with tax rates.
Yeah, I think the point is we've seen. It depends who you talk to, right? But we see a variety of exits. And I always caution a client, it looks great. I can model this out for 1202. And they're like, this is amazing, right? That you're telling me this is a dream, right? And I'm like, you're right. I mean, if everything works out, it's great. But I can tell you, I can give you 10 different fact patterns we've seen where it didn't work out. And one of the themes we see is buyers not willing to buy C Corp stock. Or maybe they're willing to do it and there's a discount involved. And it doesn't always happen, but it's just a word of caution we throw out.
In the SaaS markets, right? Because in the SaaS markets, almost all these companies will get sold as a multiple of revenue.
Yeah, and also if your buyer is the big exception here, if your buyer is like a big consolidated group or a public company, they're happy to buy C Corp stock, right? If it's Google or Adobe or I don't know who.
In this space that we're talking about
Yeah.
here, yeah, I agree. They're strategic. They're going to flip it. They're not looking for deductions. Yeah. And that's what we're here for, right, in SaaS.
Between lifestyle and a scalable venture. Scalable venture is why you do
I agree.
not for lifestyle.
Not a lifestyle company. What we would call a lifestyle company. A job for someone. Entrepreneur, yeah.
Like a consulting firm.
We still good on time?
So time check, we're at
okay?
5
5
minutes to
minutes?
go. We've done had a nice discussion here. Maybe we can wrap it up and break your questions forward.
Yeah, any questions? Well, just real quick, then we could talk. Josh, you want to talk just You know, it is possible. So if you started your business as an LLC taxed as a partnership or an S corp, and you want to go 1202, it is certainly possible to go 1202. The couple of the big points would be that you only start your holding period once you convert to a corporation. So your holding period during the time you're an LLC won't count for the 5-year hold. Another big point would be that I spoke specifically, we talked about that $50 million test that you normally look to tax basis. One big exception is if you're a partnership and you convert to a C corp, you measure all the assets based on fair market value at that time. So if the partnership's fair market value is over $50 million, then you're not able to convert that partnership to a C corp and have it be a 1202 company.
But there's a time in play there. If you catch it at 49 million is your play, 10 times 49 million, there's that 500 million-ish number that we talked about on the early slide, right?
That's right. And a little more, S corp's a little more complicated. It's not quite as easy as a partnership, but there are still ways to do it. Typically with an S corp, you're going to form a new C corp under the S corp. But there are ways to do it. Not as clean as the partnership. Partnership can be as clean as filing a piece of paper with the IRS saying, I want it to be a C corp. We can't quite do that for an S corp.
Right. It's not as simple as revoking your S election.
That's right.
Yep.
Okay. Any other? Oh yeah.
So a couple practical tips. I would just kind of reiterate: document your gross asset value every time you issue stock. We said that one time, and I think that's pertinent to be managing your stock ledger that way. Ensuring each year that you stay qualifying. That's as you continue to issue stock, right? Monitoring your transactions. And we pointed out at the beginning, coming full circle now, that remember that gain exclusion is going to happen at the individual return with some stock founder sitting in front of TurboTax at midnight on April 14th. So help them get it right.
I mean, to think about it more, if there's an audit involved, the audit is the individual. The audit is not the company. So if there's a gain exclusion claimed and the IRS disagrees, the IRS is not auditing the company, they're auditing the shareholders. So if you're a company giving advice, you always want to be a little careful because you can give advice as to the company. You can say, I think we're a qualified small business. You may not know everything that shareholders done. Have they transferred it to a trust? Who knows what they've done? So just a little careful. Yeah, it's tricky. Good. Okay, well, we'll leave it there, but we're here after if there's questions.
Awesome. Let's get a big round of applause for Eid Bailey with Josh and Adam. Want to thank you again for coming out today. Our next event is going to be December 3rd with Transaction Advisory by Tanner CPAs. Take advantage of these experts up here right now. If you've got questions, we're available. We're here. And thanks again for coming out, and have a great rest of your week. Thank you.